Depending on which source you listen to, 80%, 90%, or even up to 94% of the most well-educated, highly trained fund managers with the best analytical tools still fail to beat even a simple stock market index. The implication here is very clear. Doing research and crunching numbers trying to beat the market is virtually impossible, since any information that you may find is already known and priced in by an efficient market that knows everything related to stocks and values them at exactly what they're worth. But what if this efficient market hypothesis was wrong? What if the market wasn't some monolithic entity that exists in a vacuum, but rather that the market is influenced by flawed human perceptions and the decisions that we make based on those flawed perceptions? What if the principle of reflexivity, as outlined in the Alchemy of Finance, plays a bigger role than we think? Hey everyone, and welcome back. This is the Part-Time Economist, and in today's video we are talking all about the alchemy of finance, efficient markets, and the principle of reflexivity. But before we get started, I want to be clear, this is not an investing video, it's not a financial advice video, it's more of an economic theory video and kind of a book review rolled into one. So please do not make any kind of investing decision or do anything with your money based on what I tell you here today. With that being said, I think we really need to talk about the principle of reflexivity and how it relates to the efficient market hypothesis, because everywhere you look, on virtually every mainstream economic channel, news outlet, you're going to find people telling you that it's virtually impossible to beat the market. Books such as The Simple Path to Wealth by J.L. Collins, which I absolutely love. It's a great book, but it basically says the most solid investing strategy is to invest in a ETF that tracks the price of the market. Everywhere you look, we see examples of fund managers, people that have advanced degrees, tons of analytical tools, and 94% of fund managers cannot beat the stock market index. Even the legendary Oracle of Omaha, Warren Buffett himself, who is known for beating the market, says that for the vast majority of people, just investing into a market index is a pretty solid choice. And it's not just the data. We have economic theory that supports this idea that you can't really beat the market in the long term. For example, we have the efficient market hypothesis, which basically says that the stock market is kind of like a perfectly competitive market. There's lots of participants, all the information is known, there's low barriers to entry, and the price of a stock is valued at exactly what it should be. All the information has already been priced in. So taken together, we've got the theory, we've got the experts telling us we can't beat the market, and we have significant amounts of data that shows us that people generally don't beat the market over the long term. So why is George Soros talking about this principle of reflexivity, and why is he hinting at this idea that efficient markets might not necessarily always be right? Well, to understand the principle of reflexivity, I want us to take a step back. Just for a minute, forget about stocks, forget about mutual funds, just think about a market that you are familiar with. Going to the grocery store. Now, let's just suppose out of the blue one day, you go to the grocery store and they are out of spaghetti. So you love spaghetti. Next week when you go back to the store, you say, you know what? They were out of spaghetti. I'm going to get a couple extra packs just in case they run out again. So you get your spaghetti. You're all nice and happy because you are having pasta for dinner. But the person who comes to the store after you, they say, oh my goodness, there's no spaghetti. So when they come back next week, they happen to get there a little bit earlier than you, and they say, thank goodness there's spaghetti on the shelves. I am buying all of it. So they get their spaghetti, and now they are happy. But when you come to the store, there is no spaghetti. Why is there no spaghetti? Well, because the person before you bought all the spaghetti. Why did the person before you buy all the spaghetti? Well, because the week before that, when they came, there was no spaghetti. So the idea here is that the decisions that you as an individual make, the perceptions that you have, influence things well beyond you. And we can see even real life examples of this. If we go back to 2019, 2020, remember when people were hoarding toilet paper? Even if you realistically knew that you had enough toilet paper, your perception was that next time you went to the store, there wouldn't be enough. So your perception, which may or may not have been flawed, caused you to make a decision to purchase toilet paper. And as more people did that, it created a shortage. So it's not just that the market exists, but the market is influenced by us and we are influenced by the market, right? So if you wouldn't have been hoarding spaghetti, that other person, they wouldn't have felt the need to hoard spaghetti, which in turn would have meant that when you went on the third trip to the store, you actually would have had plenty of spaghetti to buy. But let's tie this back to the stock market. To summarize the principle of reflexivity, the idea is that in the real world, people's thinking finds expression not only in statements, but of course in various forms of action and behavior. That makes reflexivity a very broad phenomenon that typically takes the form of feedback loops. The participant's view influences the course of events, and the course of events influences their views. This influence is continuous and circular, which can turn it into a feedback loop. So that's kind of what I was talking about with people saying there's not going to be enough toilet paper, so they buy toilet paper, which leads to there not being enough toilet paper. But let's turn it back to the stock market and specifically what it means if we're looking at financial markets. The important point is that present expectations may have a material impact on future events. So this is where reflexivity is different than efficient market, because efficient market tells us everything that is known has already been priced in. There's really no point trying to do additional research, get ahead. The market is always right, basically. But what reflexivity is telling us is that your expectations can impact the future. So if your expectations can impact the future, then that future can't be priced in because it depends on your expectations. So think of a stock. Prices are generally defined by expectations of future earnings. If I buy a stock, I'm doing so because I think the company will have earnings in the future. They will pay a dividend. I'll get my money back, hopefully make a profit. But current valuations in a reflexive manner may directly influence what will happen with the company in the future. So think of the issue and repurchase of shares. Think of corporate transactions like mergers and acquisitions. Think of credit ratings, interest rates. If customers think that a stock is going to do poorly and they push down the price below the true value, that company, if they go to issue more shares, they're going to have a hard time because they're not going to get as much money per share that they issue if the price was at the true value. We could also think of this as far as mergers and acquisitions, credit ratings, right? If a rating agency sees that a company's stock price is depressed, maybe they get a lower rating. Now they have a harder time accessing funds for capital improvements, which means they fall behind their competition, so it turns into a self-fulfilling prophecy. But let's not just talk about theory. Let's look at some real-life examples of this. If we think about things like GameStop, remember when everyone said, hey, if we just pile into GameStop, it's going to do really well. GameStop was kind of on life support. People started investing in it, and even now the price is way above where it was prior to people investing in this. Another place where reflexivity comes into play is anything related to bank runs. And where I see this the most often is cryptocurrency. If you remember back in November of 2022, when FTX, the cryptocurrency exchange, was collapsing, they were coming online, they were saying, hey, this is just a liquidity crunch. We have the ability to basically meet all of our demands, right? And could they meet all their demands or could they not? This is where reflexivity is so important because the truth value of a statement depends on how people perceive that statement. So think of this. Let's suppose I come to you and I say, hey, the sky is red, right? The sky is either red or it's not. It doesn't matter what you think. Now, let's suppose instead I say that my cryptocurrency exchange can meet all of our deposits. If people accept that and they say, hey, this crypto exchange is solid, I don't need to withdraw my money, then I can meet all my deposits. But if people don't believe that, if people say, I don't trust you, I don't think you can meet your deposits, and they start pulling out, then maybe now I didn't expect all of these people to withdraw at once, so I can't meet my deposits. So the key principle of reflexivity is that the truth value of a statement can depend on whether or not people accept that. So there's this constant interplay between something is going to be true because people believe it to be true or people believe it not to be true. So it's basically a self-fulfilling prophecy is the way that I would describe it. So GameStop, cryptocurrency exchanges, that's where I see it a lot. You have the example anytime Binance, right? When there's any kind of rumor, CZ will get on there and he'll say, hey, this is just fear, uncertainty, and doubt, right? The idea is that if you can get people to kind of just discount this information and not act on it, it's going to be beneficial to you. So that's something I find very interesting, but let's talk back to general theory and not specific examples. Do I believe that the efficient market hypothesis is correct, or do I think reflexivity is correct? Well, as with almost all of these things, I don't think there is a perfect answer. What I will say is that I think the degree to which a market is efficient depends on the market structure. So if we look at this article here, we can see that when it comes to managers of U.S. real estate funds, 62.5% of the managers outperformed the market. Now, if you factor out fees, it's only 25%. However, fees don't determine whether or not they outperform the market. It matters for you as an investor, but as far as market theory, it doesn't impact the ability to outperform, right? So you still outperformed, it's just the customer underperformed after fees. But in a market theory sense, 62.5% still overperformed their index. If we go to things such as bond funds, we're looking at 59.5% outperforming the market. So still significantly higher than 50%. If we go down to these large equity funds, we're only outperforming 17.2%, which means that somewhere around 82% is either failing to beat the index or just keeping up with the index. And I find this very interesting. So I want to share my two theories. The first is that the degree to which a market is efficient, the degree to which the efficient market hypothesis holds, is directly related to how much the market in question approaches a perfectly competitive market. The second is that the principle of reflexivity can still manifest regardless of the market structure. So first off, the degree to which a market is efficient is going to be related to how close it is to a perfectly competitive market. So if we look at the equity markets, where only 17.2% of these managers are outperforming the market. If we're looking at some of the other longer term studies, so you look over a 10-year, 5-year, 25-year period, that number dips even further. So I've seen things as high as 82% fail to outperform the market. So if we're looking at this, equity markets, we have a large number of competitors. We have publicly available information, right? We have the SEC filings, we have quarterly reports, annual reports. At least in the US, a lot of that information, almost all of it is public. And if you have non-public information, you're not supposed to trade on it. So the equity markets approach a perfectly competitive market. And consequently, you can see that it's very difficult to outperform in a perfectly competitive market, very similar to how firms in a perfectly competitive market expect zero economic profit in the long run. Doesn't mean they don't get any profit, but zero economic profit, which is a subject for a different video. However, when we look at markets where there is less publicly available information, where there are higher barriers to entry, right, such as the real estate market. So think about to start trading stocks, you open a free brokerage account, you can throw $5-10 into a stock. With real estate, you've got to go through a lengthy purchase process. You've got to research. The information isn't just going to be in some quarterly filing on the SEC website or the investor relations tab of a corporate website. There's a lot more where you can find these opportunities because, again, the market is less perfectly competitive. And then if we're looking at bonds, again, somewhere kind of between real estate and the stock market. So that's my first theory, is that the more perfectly competitive a market is, the less likely you are to be able to kind of find those opportunities to exceed the market specifically in the long term. However, I do think that reflexivity can still manifest in any type of a market. So where does all of this leave us? Well, I would like to leave you with two key thoughts. And again, these are completely my own thoughts, so take them for what they're worth. My first thought is that the efficient market hypothesis in general does a pretty good job of explaining equity markets. It does a good job of explaining markets where there's lots of information, lots of participants, low barriers to entry, right? Things like the equity markets. I think it does a good job. Now, it's obviously not perfect. Any economic model is going to be an abstraction of reality that helps us to generalize and understand as opposed to being 100% accurate all of the time. That being said, I think efficient market hypothesis is pretty good for equity markets. Now, there's always going to be fluctuations. The corollary to that is that the farther we get away from a perfectly competitive market, so we start getting into things like real estate, bonds, where you do need specialized experience, where you do not have that publicly available information to the same degree, where you do have to do more search and transaction costs. When you start getting into things like that, I think the efficient market hypothesis doesn't really hold, doesn't really apply there to the same degree. The second thing is that I think even in the equity markets, even in these things that are perfectly competitive markets, reflexivity still plays a role. There's lots of examples. Bank runs, in my mind, are the biggest example. The ability for perceptions to affect a company's stock price, which then impacts how the company actually does, I think that's something that we always need to keep in mind. So, key takeaway, efficient market hypothesis can be useful, but we always have to keep in mind that no economic model is going to be 100% accurate all of the time. There's always going to be those exceptions, reflexivity being just one of many different things that can cause the market to depart from all of these nice, clean economic models that economists love to come up with. So, as always, this video is not financial advice, but I do appreciate you sticking around and watching. I hope you found it useful, and I'll see you next time.